program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Thanks for joining us here at Ausbiz. Let's get across what happened on Friday to round out the week. Global equities finishing at new record highs despite uncertainty around the US government shutdown. Now on Wall Street, both the S&P 500 and Dow closed at record highs in a volatile session as investors remain buoyed by the prospect of further interest rate cuts. However, tech shares dragged the Nasdaq lower. And for the week, the S&P and Dow gained 1.1%, and Nasdaq rose 1.3%. On Friday, shares of Applied Materials fell after the chip equipment maker forecast a $600 million hit to fiscal 26 revenue. Among the mega cap tech stocks, shares of Tesla fell, along with Meta, which was off more than 2%, Apple rising slightly. And shares of USA Rare Earth surged after the company said it was in close communication with the White House. Well, a bid to end the US government shutdown has failed in the Senate, while President Trump has withheld more than $2 billion of funding to Chicago and has now frozen at least $28 billion in funding for Democratic cities and states. Meanwhile, on the data docket, US services sector activity stalled in September amid a sharp slowdown in new orders, while subdued employment added to mounting evidence of a sluggish labour market. On the geopolitical front, US Secretary of State Marco Rubio has said that the war in Gaza has not yet ended despite Israel and Hamas both agreeing to parts of President Donald Trump's peace plan. And Japan's ruling party has chosen conservative Sanae Takaichi as its leader, setting her up to become the country's first female prime minister. Well, US Treasury yields moved marginally higher in thin trading on Friday, with the 2-year at 3.58%, the 10-year at 4.12%. Australian 3-year government bond yields at around 3.58%. Markets pricing in a 40% chance the RBA cash rate will be cut by 25 basis points at the next meeting on November 4th, with only one more cut in this easing cycle. The US dollar index little change. The Aussie is currently at 65.9 US cents. Oil prices settled higher on Friday. That was prior to a meeting of OPEC Plus, which has opted to boost production further, but overall oil losing 8% last week. Brent crude futures at $64 a barrel. Copper rose more than 3%, iron ore unchanged at $103 a tonne, and gold hovering near record highs, having gained for a 7th consecutive week. Spot gold at $3,885 an ounce. And Bitcoin hitting a new record high of more than $125,000 over the weekend, but has since fallen back. Let's get across what we're seeing on global markets with a focus on the US. Chad Padowitz joining us from Tulare Capital. Chad, welcome back. Good to see you again. Well, let's taking a look at equity markets, as I mentioned there, continuing to push to new record highs. What are you watching at the moment?
Yeah, look, at the moment we see an economy that's certainly not in recession, but it's certainly not that strong as well. We've got some positive narrative around interest rates coming down, capex expensing, things like that. But all in all, it does look like the narrative of AI is driving a lot of the market, and it's not really being driven by underlying fundamentals, which does create a challenge as we get into the new year. Well, I mean, a couple of months still there, but in terms of 2026 expectations still look very optimistic when one looks at the underlying economic momentum.
And I see you point out that perhaps investors shareholders aren't being rewarded as they were with dividends and buybacks at levels seen during a recession, essentially.
Yeah, well, obviously with the market's going up faster than the economic growth that supports it, you don't have the earnings to give back to shareholders that you once did. So in terms of dividend yield plus net share buybacks, you're looking at numbers, that are slightly below 3%, which hit, close to around 5% at their highs over the last several years. So in terms of money coming back to shareholders, it's at, multi-decade lows. And therefore you're more reliant on capital gains to get the returns that perhaps you want or expect. So it does put more pressure on that side, which, as I said, in an economy that's probably not growing fast enough to support those expectations, it does create some challenge.
And is there expectation perhaps that's going to continue to diminish? And as such, what do investors need to do if they're looking for something of a return there?
Yeah, well, we think you certainly need to look at alternative sources of return, other sources of income generation, perhaps move away from the valuation challenges that happen at the index level and look outside of that. Perhaps more value type strategies or even less into the US, which is driving some of those valuation extremes. So you certainly, we think, have to do something different. Relying on what got you here, we don't think will be the solution for the next, several years going forward.
Now, I see, Chad, as far as the US economy is concerned, you're saying a key piece of the puzzle remains the labour market. What are you seeing there at the moment? Just had some further detail there, of course, just in terms of what we're seeing. I mean, are we seeing sort of tightness there? What are you anticipating? Because it's fairly sluggish at this point.
Yeah, well, there's a few things going on that make it a somewhat complex environment this time. On the one hand, yes, the economy itself isn't generating a significant amount of labour demand. So you've got a sluggishness there, and you're seeing that in the payroll numbers and certainly in the revision numbers. So the expectations of what jobs growth would be is turning out to be not as strong. But on the other hand, you also have far less migration into the US, and you've also got some pretty well publicized deportations as well. So the foreign source of labour is actually coming down, which is creating a tightness. So whether the lack of demand for labour outweighs the tightness that comes from less supply, that's what makes it somewhat more complicated this time. And we'll see how that plays out.
And added to that at the moment, Chad, of course, is the US government shutdown with as many as 750,000 federal jobs they've been temporarily laid off, and expectations that Donald Trump will use this as an opportunity to make many of those job losses permanent.
Yeah, well, we'll see. Generally, these government shutdowns last for a couple of weeks, and none of the political parties want to get blamed for for a long-term shutdown. So they generally come to some level of agreement, which makes the implications of that event, pretty short-term. We'll see if this is somewhat different, and they're talking about using it as an excuse to, get rid of unproductive government workers. But that may very well just be a negotiation tactic as well. So, at the moment, it's only been a couple of days. It's more if it goes into a couple of weeks, that's when it probably becomes more relevant.
Chad, let's turn to a stock in focus for you in the pharmaceuticals, Pfizer being the one you're looking at. Now, of course, did make news last week, stock soaring off the back of an agreement with President Trump. They're essentially Pfizer committing to those lower prices to match imports, and as a result, it's going to avoid those tariffs. How's this playing out?
Yeah, well, Pfizer, coming off the sort of COVID vaccine revenue fall off, because obviously they made a tremendous amount of money, on the COVID-19 vaccine, and the revenue came down on the back of that. The shares became very attractively priced. So they did bounce quite a bit last week, as you mentioned, on that announcement. But as we stand today, it's trading on about a 6.3% dividend yield, under 9 times PE. It is, as we know, a large company, 150 billion market cap, and quite a diversified product set. So we see it as very attractively priced. They're on the front foot of, let's call it, relationship with the government in terms of making sure that they can sell their products at a fair and profitable price. So we see them standing in a good place given the valuation challenges and economic challenges we've already discussed.
Chad, great to get across what you are seeing there at Tulare Capital. Thanks so much for joining us.
You're welcome. Thank you.
Okay, let's return home. Taking a look, just before we get going, we're expecting a positive start. Let's bring up the futures there, currently up around 0.33%. We're going to be pushing towards a new record high essentially if we get going well. So see if that pans out this week or even today. And we'll get right across that in just a couple of minutes. Please stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in Trusted Advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.